Welcome to the Commercial Real Estate Podcast powered by First National. I am Adam Pwadek, sitting here with Aaron Cameron at the Toronto Real Estate Forum 2023 edition. You may or may not be able to hear some of the background noise, but it's packed as usual. This is part of our speaker video series, sponsored by Dow Vukovic, ML Emporio Properties, and Turner Townsend. We thank them for the support. But most importantly, we have a returning guest, Scott MacPherson, Head of Canada Capital Markets, Cushman and Wakefield. Welcome back, Scott.
Thank you. Thanks for having me.
Scott, before we go into the questioning, first and foremost, I got to say, I can't believe we're back here at Treff already. Like, it feels like 3 months ago that we were sitting here doing this last time, which would indicate to me 2023 has been a very busy year. Not necessarily from a transaction base, well, clearly not from a transaction base, but just the amount of thought you've had to put into every single aspect of your business. And we're in the debt side, on the lending side, and it's been every week it feels like another, not a crisis, just another thing where like that needs to be addressed immediately. Like you're constantly on high alert, right? So I mean, it means the weeks have flown by because you're constantly worried about something or the next thing that might happen. Anyway, we're here now. Let's get into Scott. I have no way to segue yet. I'm clearly already exhausted. This is episode number 1 of 9 we're going to record here. So for those holding on and keeping count, Scott's got the fresh version of us. By the time we get to the 9th, it's just going to be, and what else you want to talk about? Exactly. Thanks, Scott, for coming on. Appreciate it.
Oh, thank you.
So Scott, as mentioned, is with Cushman Wakefield, but the area of brokerage that he occupies is a little different than most because he's got a capital markets focus. We did cover his background last time, but it would be best to set the stage with your area of expertise for the listeners because it's not just straightforward.
It was like 3 or 4 years ago?
No, less than that. I think it was about a year ago.
Oh, okay.
Yeah.
See, time's flown.
Yeah.
What's crazy is looking at that picture behind you there. Thank God the listener doesn't get to see the visuals, but I had black hair, and so this is what This is what 2023 is
done. Yeah,
done to me, so.
That was taken 6 months ago.
Yeah, and now I'm trying to grow the hair out just in case it's the last of the hair.
Last party?
Next picture will be me bald in that circle. So, thank you so much, gentlemen. Our team is a true capital markets group. We do a lot of different things. Investment sales, obviously, Cushman's known for that, like many of the other brokerages, but what the listener might not know is our group raises capital for open-end and closed-end funds. We do single LP capital raises. We do debt mortgage brokerage up and down the capital stack. And, we've got a really robust capital markets team with the capital intelligence.
Great.
How was your 2023? Well, maybe we'll start there.
But, to your point, it was definitely a year of thinking, which I loved, right? It was great. A lot of our clients were obviously, some of the concerns that we had maybe highlighted on your podcast the year before were kind of, those trends continued to evolve. And I think our team got to work right away at the start of the year and looked at different recap strategies. Where was the capital going to come from? And, it's been challenging. In that sense, obviously transaction volumes are off, but our debt book is kind of as a result grown. So we were having to move a lot of people to that side of the capital stack as the equity piece was becoming less and less available and sources were kind of sidelined.
So I'm just first and foremost, I'm ignorant to a lot of the stuff that you do. I could talk about the debt side of the capital, but as soon as it gets past that, I'm not really that familiar, to be quite honest. So let's start with the basics. Debt's gone up a couple 100 basis points, if not more, in the year and a half, let's say, whatever, doesn't matter, but it's up, right? So if, 5-year interest rate, for all intents and purposes, 5.5%. Let's pick a number. Equity's got to be more than that. Has it risen as drastically? And how does that play itself out in your world? Are yield expectations changed?
Oh,
I think if that debt cost goes up, then it deteriorates the yield on the equity, right? So how does that play itself out?
Depending on the institution, whether it's an institutional capital source or say it's a private capital source, they have different return thresholds. They kind of benchmark off of different
are they using Canada's? Are they using a spread? I want to earn a spread over the risk-free rate.
Corporates. So they'll look at corporates. They'll look at, BAAs or, AAA, single A's, and they benchmark off of that. If they're more institutional, that's what they do. And generally, we kind of see, corporates plus 200 as kind of their starting point for like an unlevered position. And the private buyer who's more of a levered buyer, obviously, they're a little bit more like
Feels good. Let's do it.
Yeah, or it's, I want, my coupon to be higher than a 12, right, or a 13. And so depending on the strategy across all, whether it's core plus, value add, or opportunistic, we've definitely seen yield return expectations widen out by probably the same, couple hundred basis
Where are
points.
triple B corporates? Do you know off the top of your head right now?
Like
350, I think.
No, higher than that.
Okay.
Yeah, closer to 5.
Oh, wow.
5.5.
Okay. I guessed wrong.
Yeah. Like
So that's the floor of any return, just to start off with. That's
well, 200 above, because they'll look at it and say, okay, I can get 5.5 on the bond. What's my premium for real estate? And if it's multi or industrial, you're probably adding 200 bips, and then it kind of goes from there. But like I would say, if you're talking to a pension fund, if they were active, they would probably tell you today they need to get close to a 7.5, 8 unlevered, regardless of the product. That's the starting point.
Does that exist? I mean, there must be.
Well, so again,
is that just the cap rate? Is that kind of the same thing?
A little bit. I think cost of funds across the board. Again, the private buyer uses debt, the levered buyer, I should say. They're either working to a free cash flow number that's still the same as it was in 2021. But obviously, as your cost of funds have gone up, and you're trying to work back to that same free cash flow number to pay your distributions, something's got to move, and it's cap rate, right? So we kind of say a good rule of thumb is to keep that true. Every 100 basis points that your cost of funds move, whether it's debt or equity, the cap rate's got to shift 25 basis points. Same is true if all of your cost of funds are compressing, right? So if your funds are compressing, cost of funds are compressing by 100 basis points, your cap's going to come down 25 bips, and you kind of carry that on. So.
Well, but one of the saving graces of that formula is that when interest rates took off in March 2022, the gap between, we measure against the 10-year GOC is kind of, but the gap was enormous. The widest it had been in 10 years. As a result, of course, yields going near zero over early COVID. So there would have been some slack in that formula when interest rates started going up, but at this point, it's indisputable that there's been significant move in cap rates.
And you can see it just in transaction volumes, right? So if you follow that curve up, you can just see it drop quarter by quarter by quarter. And, this is likely going to be the first sub $45 billion transaction year in, over a decade, right? Probably since the GFC.
And there's been some really large transactions, though.
Yeah, there has been. I mean, obviously at the start of the year, you had Dream with GIC take down Summit, right? And that was alarming and a fantastic move for them. But they clearly, they got a kind of a great return on that and worked for all parties. But really, I think we saw Q2, Q3 just as a complete drop-off, right? I think we're sitting at about 38 billion so far in total trades. Wow. And, when the market's tough like that, I think a large part of our clients come to us and they say, okay, like I've got a roll next year, like, I'd try and monetize that through financing. Is the sale the right way? And, we're saying not really, right? So do you look at shorter term debt? Do you kind of try to bridge yourself to get into that? I hate you're going to hear this 9 times, survive till 25 mentality kick in. Yeah, I know. You can give me that to the listener. I'm getting that look like, oh my God, that's the first of 9 times we're going to hear.
Survive till 25 is funny because this time last year it was Q3 2023. So that was the saying. Everyone was saying, we just got to make it to Q3 2023 and we're going to be back riding the unicorn and the.
I don't think I did. I think I was the grumpy Scotsman. He was like, no, 23 is a write-off. Go golfing.
Well, if you go back 30 years too, of course, survive to 95 was the.
Well, I think it's really interesting. Like Benjamin obviously was just ahead of this time slot, and obviously he's even cautioning, thinking that 24 is going to see a lot of activity just because, I think the bonds will react slow. We will see that compression in the benchmarks, but again, it's not necessarily pricing discovery still is happening today. So,
well, I mean, I don't know how many people pick up on it, but he said he said interest rates are coming down 200 basis points, but he means basically the overnight rate. So prime will come down to 5.5. When prime was 5.5, 18 years ago, the 10-year Government of Canada bond hovered around 4%.
I was going to say,
guess where the 10-year Government of Canada bond is right now?
Yeah, 386.
Yeah, right. So I mean, prime might come down 200 basis points. That doesn't mean bond yields are going to drop 200 basis points. They actually could already be priced in to that prime rate, and it's just going to stay flat. Anyway, let's not go down that rabbit hole. I've been thinking about how to compartmentalize this conversation with you, Scott, and perhaps the best way to go about it is kind of just go around the horn from public to private and just the different approaches that you're seeing right now from the different types of clients. So starting with private, I mean, you tell me, but pension funds, I guess investment cos, life insurance companies, like who are the groups, and how do all of their different cost of capital kind of implicate the way that they're seeing the year of 2024 into 2025?
So the pension funds, I think, have been cautiously looking at real estate again. Obviously, last year, I think the big talk was the denominator effect with, bonds and equities doing what they were doing, and then the over-allocation issue that a large portion of them were facing.
I mean, to real estate.
To real estate, correct.
Is that just because other things in their portfolio have moved and they've got these
correct
these
so
buckets they've got to maintain?
Expand on denominator
exactly. As that shrinks due to sell-off or valuation drops, the value of real estate was
going on,
becoming a bigger piece of the pie.
And is that
and then
predominantly true across all pension funds, or for most of them?
For the most part, and I think they try to target real estate in between. Again, this is an average 10 to 15%.
Right,
and that's double what it was 20 years ago.
Definitely, right? Like if you read the old private equity books, it was like 7. 6, right? So it definitely has been a bigger allocation for them, and then obviously it's a great asset class. That's why we're all here. But what we've heard from a lot of the pension funds, and we've talked to kind of the top 100 in Canada frequently, is their shift on, say, core was a large part of their product, probably still will be in the future.
Define core.
Core being income producing kind of CBD type assets, or core industrial product, lightly levered or not at all. And so, their core investment strategies have shifted in a way where, we've seen a lot of that money move towards credit, so debt, right? And I think what they're seeing in whether they're investing in debt funds or they've built out their own debt platforms, that's, kind of unique to this part of the cycle. They're seeing double-digit returns, and they're like, hey, we're ahead of our common equity position. So, we're first in line in the capital stack. That feels really secure. I'm getting better returns.
Really, because we don't feel that secure as lenders. Anyway, false sense of security. Keep going.
But I think they look at it and they underwrite the asset much like how they would, acquire the asset, and just they're in a really good position in the credit position of the capital stack. So we've seen that. We've seen a lot of capital move towards that. Domestically, it's tough. I think a lot of them have 50+% Canada, and they probably want to get that down towards 50 or lower and take advantage of the markets in the United States and whatnot, where they're probably seeing a higher yield return.
How are they marking their assets, the values?
There's a disconnect there.
All right, so I got to be cautious here, right? Being an advisor, I think
no one's listening.
So we did actually a real interesting study. We looked at investment managers, and we looked at all the kind of open-end funds, which are the ones that would maybe be challenged or not challenged with redemptions. And what we found was those investment managers that had largely institutional capital were prudent on moving their book value and marking to market and being within kind of 50 bips of the market. They've literally seen kind of single digit, if not zero redemptions, right? And they're kind of there are many of the names that are here this week.
Those are the investment trusts, but pension funds, they've been much more likely to do it. Would it
Yeah, so pension funds, I think,
different motivation, right?
well, and I think, you know, domestically, a lot of pension funds have been telling us, you know, that, and again, this could be a cyclical thing. They're looking at either buying platforms where they're more of a direct investor versus being a fund investor. They have the local expertise here. Like if you're Hoop, for example, right? Eric's got a robust team, skills across AM, portfolio management, you name it. He likely doesn't need to invest in a fund. When he looks in Europe, it's maybe a different story, or he co-invests with other investment managers in other markets. Don't get me wrong, they all have co-investment relationships here. But the fund model I see shifting where, you know, private capital has been the biggest contributor to funds. And that's unique. So, you know, I think a lot of the big investment managers are, don't get me wrong, they probably were 70% institutional, 20% private. They're maybe realizing they need to expand their capital source list, start looking at, you know, big family offices throughout the country and abroad, and bring that capital here to tell kind of the Canadian narrative, because the domestic pension plans are very much acting on their own behalf domestically.
Right. And then pivoting to like real estate investment trust or REITs, how is their behavior or acting? Or sorry, let me rephrase that. How is this environment impacting their behavior?
You know, I think they're looking at a lot of different things, whether it's, you know, looking at their portfolio, how do they monetize assets where they've got incredible value. They might be looking at their own NAV basis and saying, we are, you know, 20, 30, 40, 50% below our NAV, and, you know, if we can...
I'm assuming you believe the NAV.
I was about to say, but
sorry, I know.
what
no,
discount
like
do you have in your mind?
I was gonna say, like, I think some, again, those who are prudent and have marked to market, they've held good value in their price. I think all REITs have had a tough go the last 24 months, but you know, what we're hearing is they'll try and move into a cash position by themselves, by their own stock, right? Because they believe in that value. And I think the groups that do that and believe in themselves and whatnot, you'll kind of have the market follow, right? You'll have that investor base say, oh, okay, they are seeing value in their own stock. They're buying their own themselves. That's interesting. Because, again, they believe in that NAV value at the end of the day.
Is 2024 going to see more difficulty on the equity side and the raise side? All participants, I mean, we're hearing early signs that that is the case. Are you going to struggle this year trying to put together equity raises that make sense for all parties?
I think 2024 will be a year, I'm fairly optimistic for the tail end of it, because I think the knife will hit the ground, it'll hit the table, and values will at least be a little bit clearer. And then groups will activate strategies to take advantage of pricing. So the private investor is very much kind of gearing up. They're still, it's funny, you know, we pulled our kind of, again, top 100. There's in excess of $50 billion of dry powder, just with groups that we've talked to, sitting on the sidelines. So it really is about yield, and I think we're getting closer to where their expectations are. It's not like they keep moving that yield expectation out. It's when we hit here, we're probably back in the game.
So it's still kind of like vendor expectations, right? It's still kind of like a price exploration. If it's triple B plus 200 or whatever the general metric is it just the acceptance that that's what they're going to have to pay for that equity?
Yeah, I think it depends on the strategy, right? Like, I don't see a lot of people having appetite for, again, core product, right? We see a lot of groups kind of looking at value add opportunistic deals or debt as an investment. I think you probably see, like, if I was a debt group, I don't know, maybe like First National, where I have the opportunity to start like a bridge fund attached to your multi.
We'll talk later.
We'll talk later. It's not a pitch.
A new product line is born.
You could probably
I
find,
can see. Oh, Adam's already texting his clients. Like, hey, you want bridge money?
Yeah, we're starting a new fund. Yeah, I'll get Noni to send you guys an engagement letter. But the point being that, I think you're probably, whether it's through a fund vehicle or a separately managed account, groups like yours, you could easily you could probably have an easier time raising debt funds than you would if it was like, hey, oh, we're going to go buy income producing.
Yeah.
Even if it was an industrial, it's just a tough sell today.
Yeah, and it's. I mean, I'm assuming everything's got a price, but it's just the price that doesn't make sense for me. Looking to buy that asset.
Well, and like no one wants to admit their peak purchases 2 years ago, right? Obviously, with the low cost of fund environment, cheap capital, it flooded the market, right? We saw cap rates drop, and you had your highest volume activity year, and a lot of that's on their books, and they're just, you'll kind of extend and pretend is what I call it, right? And see if you can move your financing out. If you're in multi or industrial, you're definitely hoping that the rental increase, even though cap rates might be widening out, your income stream is basically saving your ass on value.
Well, also with the $50 billion in dry powder sitting out there, I mean, I've already mentioned the early 90s once, and I'll mention it again. Then there was just complete lack of capital market.
A totally different scenario right now, right?
Which drove prices.
That wasn't a liquidity crisis. This is not that, right?
So with the flood of capital available, though, will that help buoy prices? Maybe just the gap between cap rates and borrowing rates will get very thin, just because people have to deploy capital or they're out of a job.
But here's the question: are they going to deploy it in Canada?
That's a valid point,
right? So I don't know. So a lot of the groups that we talk to geographically are overweighted here, and again, they're looking at global opportunities because the whole world's been on sale, right? Cap rates in every corner of this planet have widened out. So it'll be interesting to see where they go, right? Do you go into the major markets in the United States? Do you go to the Eurozone and see that London is cheaper, not cheap, cheaper than it has ever been.
As a result of the strength of the Canadian buyers, I mean, however you want to define that, meaning there's the availability of capital that's still here that is from here. Has that had a downward pressure on cap rates compared to the rest of the world, where maybe the cap rates have moved more freely compared to interest rates, therefore making us a much more expensive investment?
Definitely.
Yes.
Yeah. Like I think we are a little expensive, but listen, what does Canada sell? It's your
stability.
Stability. It
Geopolitical
really
safety.
You look at everything that's going on out there, and to have your good Canadian investment manager take care of your money.
How many times have you said that?
I just thought of it, actually. But I will trademark it right now and use that somewhere. But if you look at security, and I think, I remember at the Real Cap forum, like Blake was talking, and, he's their pension.
Blake Hutchison.
Thank you.
Yeah.
For the listener.
Yeah.
He's basically moved his whole portfolio to a third, where it was infrastructure, real estate, and I forgot what maybe some other equities probably. And that was his focus. And what was interesting is that's a huge weighting for real estate. Obviously, it's what the man knows well. And he sells Canada probably better than anyone else on the global forum. And his biggest things, security. And then he gets into, more kind of livability and all the things that we can offer here. And the investor is aware of that. Like it's there. But, it's tough sometimes when people are looking at, but I can get a 5 cap in New York.
Yeah.
For an apartment building.
I'm going to go down into the weeds. Maybe that's not appropriate, but let's just do it anyway, because I wanted to ask this question. So and if it's the wrong question, you just say no, we'll edit it out.
Who's going to go broke in the market in the next 6 months?
Yeah. We're definitely going to edit that out.
You got an individual that owns some really good land, however you want to define that. You got an individual that's a very good developer with no money, and then you got the guy with money. is that structure occurring today? Is that making sense? Or is that equity just saying, you know what, you can't afford me right now?
It's not that they can't afford. I think the equity is looking at. So here, let's dive into it further. Let's go to
the weeds,
the roots of the weeds.
Yeah.
And I think the investor is saying, I don't know that your residual value in land is correct because, absorption of the product's slower. The peak price per foot on the revenue assumptions is fallen off by X. And, where I used to be a high teens and a 1.8 equity multiple, I'm now well north of 20 on my opportunistic capital investment thesis and well above a 2x equity multiple. And at $150 a buildable, let's just say if it's multifamily rental or whatever, you pick the place. It doesn't work. It doesn't pencil. So, and then not to say that a lot of developers do this, but it's been, I think, an incredible part of the cycle to learn from how do we use leverage appropriately versus, being a drunken sailor and, maybe taking all of that appraisal surplus out of the pre-construction period a little too early instead of maybe keeping it in until you get to your construction financing and, not having to go back to your LPs and say, hey, because of the devaluation of the land, there's an equity call now. LPs just love that.
I'm sure. Well, that was actually going to be my next question. How is that playing itself out right now? We've got a huge $4 billion construction book, and unfortunately, there have been margin calls, right? It's just, we thought it was going to be a $100 million building when you built it. Now it's going to be a $90 million building. That's just the reality of cap rates. So you got to put in $10 million more. Who's cutting that check?
Well, they're digging deep, right? They're either going back to their LPs to do it. Don't get me wrong, the bigger groups are always fine because they're 100% of their own capital, and yes, there's still developers out there that are like that. But yeah, a large part of it is they're either re-raising capital or their existing LPs who have trusted them and maybe been with them through multiple projects just understand, okay, we got to work in this to get our original contribution back. Maybe we'll still get a bit of a pref. Maybe there's still a bit of a carry after the fact. So
are there renegotiations though? Like say you got 3 LPs of that, whatever, however the stack works, that don't or can't or unwilling, and now you've got are they just yelling and screaming in boardrooms? Like, how does that work?
I think your development manager is probably, the monthly calls are probably more weekly now, and I think they do a great job, right? Like, there are a ton of great development managers across the country, and I think they do a great job of informing their partners, whether they're institutional or private. And if you have real estate aware LPs, this is nothing that they can't
be surprised.
They're not surprised about, and so.
But it hasn't happened in years and years and years, right? So even though you know it's a risk, if it never actually happens, you're probably not that afraid of it, right? That's the.
Yeah, exactly. I mean, most
the elephant in the room is they've got 9 different investments and 9 different projects, and all of them are getting capital calls. Let's not go down that road, but that's the risk, right?
But and it's listen, there's a ton of unforeseen things. Like, who knew that the overnight rate would widen out as much as it did? So all of a sudden, your interest reserve kind of loses a couple of months.
Budgets have all inflated
everything
as a result. Right.
So it's, but what we're hearing is if you look at your majors, if you're tendering today, you are seeing value engineering opportunities that you didn't see in 2022, right? So is there still growth in hard costs? Maybe, right? Infrastructure's still busy. The Fed's still keeping construction busy. But, I think depending on what you're building, groups are working hard on value engineering their budgets and are finding ways to close that gap. And listen, our team helps out a ton on that because we do a lot of full cap stack financing. So whether it's, the debt, and then we've also done the equity, we're definitely kind of, how do we look at the debt side of things and kind of provide relief? How do we get budgets a little bit tighter? And then, just reporting that back to your capital. And so, the development managers that are absolute pros, they'll continue to have the support, I think, of their LPs. I think it's some of those younger groups, this is where they're really getting tested.
Yeah.
We're just about out of time. What's the 1 minute version of good news for 2024?
I think in 2024 we're going to see cost of funds be cheaper, right? So I think you'll see a flood of activity, hopefully, come back, or price discovery being discovered. And so getting the calculator out, getting the assumptions kind of a bit more solidified versus it being massive variables that you're always debating, because that's what we do for a living, all three of us. So kind of having a bit more of a market norm on the assumptions kind of by Q3, I think, of hopefully 24, and then seeing a little bit of more activity in Q4 next year than we've obviously seen this year. So I think next year, when I'm bald on this podcast, right, dark hair, gray, bald next, we'll talk about how the Q4 activity is hopefully higher than it is today. So that's the green shoots.
I like it.
Hopefully for 24.
And then pop the champagne in 2025? Is that
If
save it for next year's prediction?
If you survive
Yeah.
to 25, we can maybe have a cocktail or
Reverse
two.
the balding. And
Yeah, exactly. Go to Turkey, get the hair plugs in.
There you go.
Because we can afford it.
Yeah,
Money's
there you
active
go.
again. So.
Great. Scott, thanks for the time. Really appreciate
Thank
you
you,
coming on.
gentlemen.
Always a great conversation. Thanks to the Forum for hosting us. Thanks to First National for powering the podcast. A reminder to our listeners to subscribe, rate, and review if you like what you're listening to. And thanks to our sponsors, Doust Vukovic, ML Emporio Properties Limited, and Turner and Townsend. Thanks again, Scott.
Thank you, General.